Hey everyone, welcome to the Fiscal Philosophy YouTube channel. I'm a value investor. One of the most requested things I get in Discord is to show my whole portfolio. I've done it before in the Discord, but I figured maybe for newer people in there, why not just make a video out of it and show you the entire six-figure value portfolio, position by position from smallest to largest, and give some of my thoughts along the way. Now, just because I invested in these companies doesn't mean right now is the right entry point for anyone else to get into those companies. These were just companies that, I thought worked for me at the time I got in. So without much further ado, let's get into the portfolio. So here it is, the six-figure value portfolio finally revealed. And we're going from smallest to largest positions. So at the top we have CLOV. This is Clover Healthcare. This is a healthcare company. It's sort of a more speculative position. Personally, I view it as a play on the demographic shift. They prioritize Medicare Advantage plans. They also have a technological component with their Clover Assistant. So this, in my view, has a lot of potential upside. They're also moving towards GAAP profitability. Like if you look at their financial statements, there's a lot of good things going on there. And this does have sort of a negative perception from its meme stock days, but I do think it has a lot of potential, and it's worth, to me, taking a chance on a small slice of it for what I think the future value could definitely be. Next we have UWM. This is United Wholesale Mortgage, sort of my bet on the long term of the US housing market. I don't think that the American dream of home ownership is going away anytime soon. And, there's basically two major players from my perspective in this space, UWM or Rocket Mortgage. I think UWM long term eats Rocket's lunch. And so I have a little bit of this. Just want my little slice of that American dream. Gotta have a piece of that Americana, as Rick from Pawn Stars used to say. PSEC, this is just a business development company. They pay monthly. They trade at a pretty big discount to their book value. Not too much deeper than that. It's a very small position, not one that I check back in on very often just because it is such a small slice. Maybe it'll work out, maybe it won't. I won't be heartbroken or elated either way. GNL, I thought it was a REIT, but I actually noticed that the dividends I'm getting from it are qualified. So I know that they are a real estate company, but for some reason they may not qualify for REIT tax status. So I do need to circle back around and take another look at that one a little more carefully. Western Union, I've mentioned before on the Cash Flow Kings, which is live 8 p.m. Eastern almost every Saturday night with rare exceptions. Better subscribe to that. Link is in the description. So I mentioned that I like businesses that are in the business of moving money around and taking their cut rather than businesses that move things around. And Western Union is one of the oldest in the game of moving money around. Obviously, there's been a lot more competition in that space the last 15 to 20 years. And that means, hey, maybe Western Union isn't what it once was, but they are still one of the only options that's available in parts of the world where you can't really use like PayPal, for example. And they also are the go-to for either the unbanked or, things like, poor people that just, don't have good credit scores or whatever, for whatever reason, banks don't want to let them open checking accounts, or migrant workers that need to send money back home to their families in other countries around the world. Also, make sure that you're finding that like button and apprehending it no matter where in the world it is. And also, hit the subscribe button to follow my channel and strike that notification bell so you never miss another one of my uploads. Next up is KeyCorp. This is a regional bank. honestly, on this one, I feel like I let the opinions of other people maybe influence me a little bit too much towards wanting to get in. I sold some puts, ended up getting assigned on one, and of course, then at that point, I'm like, what have I really gotten myself into here? And of course, the whole Silicon Valley thing happened right after that, or not long after that. It was actually a few months later, and I was sitting there saying, do I really want KeyBank in this situation? They're a regional bank, and their risk level is of course not zero, but it is what it is. Like, I think banks will recover, so I'm not going to panic sell out of it. But definitely, if the me of today was to go back in time a year, I might second guess the decision to get into KeyBank. Vale, now this is a basic materials company. Their price will more or less fluctuate with the price of iron ore, since that's their primary product. They do also produce nickel. I just generally think in very, very long stretches of time, the world becomes more industrialized. We need more basic materials like that. And so I think in the long run, they'll just benefit from the further industrialization of the entire world. And, I think there is something to be said for owning a certain amount of just the basic materials that an industrialized civilization is built upon. It's certainly something that's probably not going to be going to zero within my lifetime, the need for what they provide. Now, granted, it may just be something where it fluctuates in a range the whole time I own it, but they do pay a pretty good dividend. They've done buybacks in the past. So when it comes to periods where they're up, my cut of that may go up over time as they do buybacks and pay out dividends. So next up, of course, we have the wonderful Palantir. So when it comes to Palantir, I got into this thing at a cost basis of right around $6.22. As you can see, current market value is like $2K. I'm up $1,400. Now, just because I've basically more than 3x'd my money in a few months on this, doesn't mean I'm a genius stock picker. It doesn't mean that everybody should go out and immediately buy everything that I buy. It just means I waited for Palantir to reach a price point where it made sense to me to start doing something. I sold a few options, got assigned 100 shares at a price I was personally comfortable with based on the financials and my predictions for future cash flow. And afterward, good news drove up the stock price. It's that simple. There's not any magic to it. There isn't, a magic formula where I can choose the exact bottom and immediately triple my money in a short period of time. It's just on this one, it happened to play out where my, the price went up really fast instead of over a long period of time. But I'm investing for long periods of time. I don't view this as something that, I'm going to try to, replicate over and over again. Because I don't think it's realistic to expect to 3x your money in a few months. Next up, we have Bank of America. Now, this is one of those banks that is basically in the too big to fail category. Berkshire also owns it. There've been opportunities to get in at like a slight discount to their book value. So, I think it's probably going to be a pretty solid compounder, and they'd like to do a pretty good amount of buybacks, and of course they pay out a steady dividend. And again, businesses that move around money, granted banks also loan out money, and there's a lot of other things involved, but I don't think that I'm going to regret owning Bank of America. BTI, well, this is one of the SIN stocks I covered in my recent SIN stock video. Price-wise, we're down a bit, but they pay out a pretty tremendous dividend, and I view them as sort of the international opportunity when it comes to nicotine products, whereas another stock we'll cover in a couple minutes here is the domestic opportunity. I happen to think the nicotine products are a decent investment, mainly because of how habitual the purchasers of those products are. It lets the companies that produce them make a very, very predictable growing stream of cash flow. So I like that aspect, the fact that they have a lot of ways they can return capital, because a lot of times they trade at very low multiples, so they can do buybacks at levels that are very accretive to shareholders, and they can pay out the majority of their cash in dividends and just directly return capital to shareholders. Very simple, and I like simple. Verizon is my choice of telecoms. If you wanted to have one telecom, AT&T, Verizon, or T-Mobile are pretty much the three big options in the US. And I personally like Verizon best because of their investments in 5G. I think there's more upside to Verizon than with other telecoms, and their price was pretty heavily beaten down. And they have a pretty big dividend that returns a lot of cash to shareholders. It doesn't grow very fast, but they do grow it. So it's almost like holding, I guess, in a sense, a bond that slowly grows its yield on cost over time, with some potential upside if 5G really does well for them. Next up, Horizon Technology Finance. Now, this is another BDC that pays monthly. I got them at a small, a pretty good discount. I think it was like maybe a 10% discount to their book value. Now they're invested in a lot of sort of tech startup type things. Think companies like Skillshare and stuff like that, which you may see advertised on YouTube and other such things. And they've managed to pay out a pretty hefty dividend. They pay monthly. They occasionally pay out special dividends. Their net interest income is probably going up since interest rates have risen. The main risk with them is, what if the companies that they give funding to, what if one of them goes out of business, or a lot of them go out of business? That's the risk you take. It's not a very big market cap. It's a few $100 million, relatively new BDC, but it shows some promise. And hey, it is a slight risk, but it's not like a giant position either. It's kind of in the middle of the pack here. So I kind of took a chance on it. Next up, you've got ARCC. This is a more established BDC, a little bit more boring. Now they pay quarterly, but they pay a solid dividend. Got them when their price was slightly, hit temporarily. So I'm getting some price appreciation plus the 10 or 11% or whatever on the dividend. And I think that'll just be like a kind of a solid, low volatility position in the portfolio. Nothing terribly remarkable to write home about there. Paramount. Now, this is one I get a lot of criticism for because, it's a falling knife cigar butt apparently. But this falling knife cigar butt, they're definitely taking hits on ad revenue, especially with their live TV segment. They took a big hit this year, and streaming, of course, still hasn't turned profitable yet for them. As far as I know to date, Netflix is still the only streaming service that actually is profitable on just the streaming part of the business. And that's all they do, so it makes sense they'd be good at it. But Paramount did inch closer. Like they're definitely closing that profitability gap, and they're at what I believe is 63 million subscribers on Paramount Plus as of the last earnings. So, I mean, they've got a lot of people on their service, and don't sleep on them, okay? They've got all the old Viacom stuff. So, and some of the shows are still running, like South Park. They've got the entirety of the Star Trek, universe, both. So you've got both like the classic stuff, like the original series, the Next Generation, all that stuff, and the newer ones, like Picard, Strange New Worlds, all that. So Paramount is definitely looking pretty strong. From a content perspective, I think they're pretty asset rich, and yeah, I just think that for what they have, they're undervalued. Walgreens, another healthcare company. Now they've been really beaten up because they're also a retail company, and retail has just been draxed this year. Their CEO stepped down. They got hit with a $6 billion lawsuit. It's just been one thing after another this year. Were I to go back in time, I might have been a little more patient on them and seen how the post-COVID world played out a little bit longer before dipping my toe in. And I might have taken a closer look at CVS. But as it stands, I do believe that the stock in general is pretty likely to recover to a more rational price point. I just think it is beaten down to an extent that's past what the reality warrants. Smith & Wesson. So this thing it's pretty cyclical, but they have a philosophy of avoiding debt for the most part, growing their relatively new dividend, buying back shares, and just driving shareholder value is a big priority for them. And, I got them, I got in here at a pretty low point in their sales cycle. They got beaten up a lot. I had to be red in the position for a while because, again, I don't expect to time the bottom perfectly on everything, but there was a point where they looked undervalued to me. That's where I got in, and they've recovered really nicely. They're up pretty big this year. I think like 50% or so, like maybe even a little bit more. So, I'm doing pretty well on Smith & Wesson. I think my cost basis, though, is like 11 something per share. HPQ. This is another one that routinely trades at an extremely low multiple. And honestly, I think that the majority of my return on this will be realized through buybacks when their price is beaten up. They buy back the shares, lower that share count. My share of future earnings and cash flow goes up. And of course, the more shares they remove from existence, the fewer shares they have to pay out their dividend on, and they can drive up the dividend to the remaining shareholders more quickly. And I think over time, my yield on cost is going to go up a lot on this, and I'll be pretty happy. It'll just be a nice little income producer in the portfolio. I'm not like going all in on it or anything. I just, I think it's probably going to produce me a pretty solid return, probably like 11.5%, 12%, something in that range. PayPal. This stock's been absolutely beaten to crap lately. So I have 100 relatively new shares in this. They have, of course, they had a pretty good earnings this last earnings call. But the stock price isn't really like jumping all that much. Now, there's been some contention that this is like a dead company. Nobody uses PayPal anymore. Well, I use PayPal all the time. They have a lot of behind-the-scenes payment processing that they do for e-commerce businesses, and they own Venmo. How many people that say, oh, nobody uses PayPal to send money anymore, are forgetting that they also own Venmo, which a lot of people are using. And then they say PayPal is not accepted on this or that. Well, and then you look at the thing that they say PayPal isn't accepted on, and the place accepts Venmo for checkout, which I actually happen to use on things like Uber and Amazon and stuff. So now maybe I'm the only one and other people aren't doing it, but I think other people probably are using Venmo on those sites. Oh, next up we have the most controversial holding that I have right now, and this is MPW Medical Properties Trust. As you can see, I am bloody as hell on this one, but I believe that it's worth around $14 per share. It's at $4.61 as of recording today, and I'm continuing to average down slowly. Right now, when it's down this much, is the hardest time psychologically to do what I know I need to do. And in spite of that, I continue to do it. Like a week and a half ago, I added another 100 shares, and I'm just going to keep periodically doing that until, I reach a point where my average is where I want it to be. And, at that point, it's just a waiting game of, does the share price recover? And if so, when? And hey, in the meantime, I'm collecting dividends, options premium, and waiting for it to play out. This thing is heavily shorted. In fact, it's shorted over 22% last time I checked. Those shorts do have to buy back to close at some point. In the meanwhile, they're on hook for both interest and the dividend. And it's funny because if retail had the enthusiasm for this that they had for like GameStop, I think we would have seen some interesting things happen already by now. But that being said, you can't, in my opinion, really get into something just expecting, for some kind of big event like a short squeeze or something. This is purely valuation based on their assets and not much else. Next up, we do have Alibaba. So, Alibaba, I'll tell you more about Alibaba right after you hit that subscribe button. Because if you've made it this far and you're not subscribed yet, what the heck are you even thinking? Is beaten up a bit the last few days. They just had earnings. They had a double beat, so they top and bottom line. But some things came out. They don't like. They're not anticipating good things from the U.S. Trade restrictions on exporting certain types of chips and semiconductors. So the stock price slumped on that. They actually announced that they're going to be a dividend company, which, that maybe that'll excite the dividend investing community about Alibaba. I don't know. But personally, I didn't buy them expecting a dividend. I thought, hey, well, they're this cheap, they can do buybacks, which they are doing buybacks as well. They bought back $1.7 billion worth of shares in the last quarter. And frankly, I think that BABA represents one of the best value opportunities in the market if you can tolerate the China factor, the risk, the geopolitical this and that, the back and forth, the volatility, the uncertainty, which I can. Next, we have Altria Group. This is, of course, my domestic tobacco or nicotine. I like to call them nicotine companies now because, frankly, they're moving more into vaping, less into tobacco as time goes on. I think, vaping's on the rise, tobacco and, combustible smoking is on the decline. Not that I think it's going to be going away fully anytime soon, but I think vaping is going to be dominant in the coming, say, 10 years. They do a respectable amount of buybacks, plus they have a very reliable growing dividend. They are a dividend king, one of the very few. And I think this is just going to be a reliable, steady stream of cash flow for the long term. Next up, we have Comcast. So this is one of my favorite stocks. As you can see, it's the second largest by current market price in the portfolio, and it's one of my absolute favorite stocks. They have streaming. Okay, they've got the Peacock network. They own all of NBC and Universal. So they own Universal Studios. They're in the theme parks. And they are one of the biggest suppliers of broadband internet to tens of millions of households in the United States. So they have, broadband internet is practically a utility this day and age. You basically need it to function in modern society. During the pandemic, you needed it to work from home effectively, etc. And I don't think people are moving away from this type of broadband internet anytime soon. Oh, and they also are in, they do have Xfinity Mobile and stuff like that, so they're in that space a little bit as well. But all in all, I think taken as a whole, this business has so much cash flow producing potential. I mean, they already produce so much, and they have, the capability to really, really drive up their dividend over time. They do pay a pretty healthy dividend. I believe they have the potential to, do buybacks at opportune moments. And frankly, they have a lot of opportunity to, grow their streaming business, which I don't think they're profitable on Peacock yet. So if they manage to sort of square that circle, as it were, they have yet another cash cow on their hands potentially. Now, their third of Hulu, it was announced that Disney would be buying that for nearly $9 billion. So they're about to get a nice big cash injection from that. So much to love about Comcast. And last but not least, possibly my absolute favorite stock in here is Intel. Intel has been a journey of dollar cost averaging for me. Okay. I'm currently up about, I think it's like 15% or so on Intel. Got assigned my first 100 shares early in 2022 at about $47. They're back up to $43. I kept selling puts right down when they were at like, $25 a share after they cut their dividend, etc. I don't scare easily. And if I believe in a company's value, I stick with it, and I just take the crashes in price as an opportunity to get my cost basis down so that I have even more upside going forward. And that's what I did with Intel, and that one really has been a demonstration that patience and giving your value proposition time to pay off can work. Now, granted, hey, it could crash back down to 25 again at some point before some of the things that they're working on as a business actually start to really pan out and show themselves on the financials. And if that happens, I will just keep averaging in. At the point that they're at now, honestly, I like my cost basis where it is. So to consider adding another, say, 100 shares or so, I would want to see a big drop in price without a big drop in my long-term outlook, basically. So that's all the stocks in my six-figure value portfolio. I hope that you found this transparent and illuminating. Somebody once, kind of mentioned, oh, hey, I'd really like to see where you short your portfolio on Discord. And I said, hey, why don't I just make it a video instead? Kill two birds with one stone. So that's why I did this. Let me know if you've got any of the same stocks in your portfolio. You can, of course, do that in the comment section down below. Also, you can do it on Discord. Link will be in the description. Thanks again for watching, everyone. Have a wonderful day.